Right, stocks finished at their highs of the week, especially led by a lot of big large cap names, despite some very bearish earnings results from Amazon and Apple. But that didn't sway the market. Sign of a really strong market is to overcome any kind of bad news that may be coming out, and that appeared to be the case overnight with some light volume selling in a lot of these large cap tech names. And then, of course, once volume kicked in, as it normally does, that's what causes gaps to fill. The stocks reversed those light volume overnight moves. And so we reversed all the way to a high. In fact, we got a cluster. So I'm going to show you where that cluster was on the charts. And we're going to talk about what drove this bullishness this week. It's not the most bullish pattern. We're going to talk about why and what was driving this action. What's been driving this action for the last month. We've had a really good 20-day move. In fact, one of the stronger 20-day moves that you'll see, especially coming off of a very relatively weak low point. It wasn't a significant drop, 5% off of a 100% rally. So not really that much of a drop to begin with, but a very strong move off that low nonetheless. One of the stronger ones you'll see. So we're going to talk about, okay, now that we've had that, what do we expect now for the next 20 days going forward, or the next expiration cycle? We've seen this type of move before, so I'm going to show you that past precedent to see what we can expect. And then we'll take a look at a stock for a trade opportunity that has reversed its own trend, not quite as explosively, not quite as to new highs, but has given us an opportunity for a little bit of a pullback by the dip opportunity. So we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, October the 29th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator here. We can see we closed on the high note after gapping down. We closed at an all-time high for the S&P 500, all-time closing high. Again, closing above all these recent highs of the week, pretty much closing at the high of the week, off 3 points, less than 3 points. Almost got a cluster, an overbought cluster with the momentum line, just a little, I think mostly because of the gap. If you take a look at the futures contract, though, we actually did get an overbought cluster, which is kind of interesting to see. Sometimes these overbought clusters, when you're starting off intermediate runs, tend to be pretty bullish. You can see back over here we had one. Over here we had a few. In this particular case, if you look at, if I were to compare, like for example, how far up above the moving average we are right now. So right now we're 3.93% above that 30-day moving average. If you compare to all these other clusters, we are further above the moving average than any of these four. And if you look at this first one that we got over here, we're also higher up above. In fact, we're about as high as we got going into that April expiration, where we kind of peaked in momentum and then just kind of went sideways for a full expiration cycle. We went sideways coming after what was initially a cluster, and you can see none of these other no other clusters over here. So needless to say, as this is a relatively strong cluster, there's a few over here that we had going into that September time frame. We had this cluster, we were further up above the moving average. These two, we were right about at where we're at right now. Same with these two. So we were, we've had some clusters at the end of intermediate runs that were more bullish. We were further up above the moving average than we are right now. But it kind of gives us an idea. But when we were just kind of trending and moving, we're not this far up above. So it kind of goes to show that this has some inklings of being like the only near-term run where the blue line gets in bullish territory, and oscillates up and down, being the only near-term run on this intermediate rally. We might get like a couple sporadic ups and downs, but no like typical 7 to 12 day rally. This, as I mentioned in Wednesday's video, this has the hallmarks of being kind of a mature intermediate run, the last intermediate run, which these last moves tend to be sporadic, erratic, shorter than normal. So this has the makings of we've been on this long-term run since COVID low point where the market sentiment line has been up above 50, or up in the bullish territory. The market sentiment line dipped a smidgen below 50 during that intermediate pullback, but never did dip in the bearish territory since the COVID low point. So this looks like this has the makings of what may be the last intermediate run before the market sentiment line makes its way back into bearish territory. And the fact that we're clustering so quickly and so far up above the moving average is another one of those signs that this may not be your typical intermediate rally that lasts multiple months of slow grinding moves to the upside. This week we also finished the weekly candle, so you can see the near-term line at very high levels on the near term. In fact, for this last 4 weeks, pretty much the entire month of October, 4 weeks have been bullish, and that's brought the near-term line out of bearish territory, which it only took these 2 weeks to get it down to such an extreme low point. Now you've got those 4 weeks that got it back up to the momentum line first to extreme highs, and then the near-term line up to extreme highs, keeping the momentum line already at high levels, at bullish levels. Though again, we're getting that we're converging more and more with the 30-week moving average, as now we're only 6% up above compared to some of these other levels. We were more than 10% up above. And of course, one more look is looking at the monthly candle, because we're ending the monthly candle, and you can see after a sharp dip to the downside on the momentum line, very similar to last May, we just completely reversed it. So we completely reversed it in June of 19, the last time we got that, and we were up above the moving average. Same thing here. The difference again is we are extremely high up above. For the last 10 years, we are extremely high. Even for the last 20 years, we're in the 98th percentile, 32% up above the moving average. So the fact that you're getting these drops down to extreme lows on the momentum line, which is typically something you see when you are either mature in a trend like this, or in a bearish move, when you're below the 30-month moving average, is when you see these dips that low. So a sign that we may be maturing. Again, we had one over here, and we've gone up another year, 2 years. We got one again. Again, it doesn't mean necessarily that we have to. We got one over here in October. We got one in 98. We went over a year longer before March 2000. The market finally peaked, at least on the NASDAQ. So it doesn't mean we have to drop tomorrow, but it does mean that we're getting more and more mature, especially considering, again, 32% up above the 30-month moving average. So there's lots of signs of the maturity, the long-term maturity in the market. It doesn't necessarily mean we're going to fall on Monday, but that cluster on the daily chart suggests that we might be stalling out with this extremely strong momentum. We might be stalling out here and might start grinding, as we saw again in this April expiration, where we went for a month, a whole expiration cycle of not going anywhere. Really, 2 expiration cycles, coming from April expiration all the way to June, where we essentially did not go anywhere before pushing up, the next 2 expiration cycles before the intermediate pullback into October. So we're kind of in that mode right now where we might not go anywhere, despite the seasonality of the markets, which is strongly bullish at this time of year. Very strong bullish move to the end of the year. But considering, remember, we are already up 25% for the year. So it kind of throws the seasonality out and makes you wonder, all this move to the upside, is that it right there, right? Have we pulled it forward here? Because, typically we go from a low point in around October expiration, and we move higher, ups and downs, so we move higher. Have we already made that move already? The cluster, again, that on ES would suggest that maybe we have. We might go a little bit higher, but we might have pulled forward a lot of that, and we might just grind now. At best, grind. At worst, if not, start more of an intermediate market sentiment decline. So That's kind of what the market forecast is looking at. If you take a look at the long-term view, you can see the nice, good Hakunashi candle this week, closing above last week's high on the Hakunashi candle. So it's a very strong close, very bullish, very high. The PPO is rising again at 6%. Keep in mind that PPO at 6% is already pretty darn high. Like if you go back, past time frames. When we went parabolic there in early 2018, it peaked at just less than 7%. We're already almost there. I know we're down from this peak, but it kind of gives you an idea. Like, don't expect that this will start a new run that will be like this one, right? That because we're already really high in the PPO compared to where we've seen in the past. And you can see the Hakunashi candle. Again, go all the way back across the left. This is about as big as the Hakunashi candles get. They'll really start to grind down from here. So I think we have pulled multiple months worth of rally into this last few weeks when it's been so strong. In fact, if you look at the rate of change chart here, this rate of change chart, and you go to this time frame of when we've been bullish. So what would this be? Let's see here. It would go from that close up to this high point. It looks like about 20 bars. So if I were to change my rate of change here to 20 bars, so you can see we've got about about 6.5%, 6.7% move. So off of that cluster to this high point is about 7%. So maybe I might have to go up, see if I can get to that 7% with one more. There we go. So there it is, up closer to that 67. Let me just try 22. I think 21 will do it, but yeah, it looks like 22 will do it as we get really close. Or 21 will do it. It gets closer to that 7% mark. So there we go right there. So, again, you go back across the left, follow my chart all across the left, and you can see this is a really good return for a 21-day period relative to what we've seen in the past. It will tend to grind from here. And all these peaks, if you follow along across the left, I don't want to move my cursor, but if you follow along all those peaks, we tend to really slow down or grind down from that point. Let's take a look at the 3 green arrow charts. And you can see that momentum is already waning. The MACD is dropping here. The MACD is dropping. The MACD is dropping. It did pick up a little bit here. Excuse me. Let's go to, this gives us a better view of it. There's the MACD dropping, the MACD dropping. A little bit of a pickup there and a little pickup on IWM2. But, there's some weakness that we're just losing momentum, which is not surprising. And when you look at it on the 2-line version, and we spent a little bit of time with this today as well in technical analysis, you've peaked already in the MACD. This is the impulse move. You've peaked already in the MACD where it looks like we're peaking here. Again, it's very similar to what we saw going into April expiration, where we went sideways for 2 months because we were on a bullish convergence for most of that time frame. So this, you expect you'll get a bullish convergence here as well, considering how bullish we are right now, that we'll get a bullish convergence here, and at best probably go sideways like we saw here in April through May into the middle of June. At that point, if you take a look at the other indicator oscillators here, it's a pretty bullish RSI and CCI. We're easily up in the upper half. Remember, the Russell is not as bullish. We're not quite above 60. We're still in very neutral zone. We're still very neutral zone here too. Not really moving in one direction or the other. That's showing up as well on the DMI. We're above 30. We're below 20 because the ADX, remember, is already pretty strongly higher. That's not the case for small cap stocks, as again we're still very neutral, very, very neutral. In fact, when you look at the trend strength indicators, we are above 2.5. We are above 65. So we do have a good intermediate trend going. Obviously, we're not above 5 or 80 yet, where we really just kind of grind. But we are definitely in this mode. When you get above the green dotted line, you can get a good trend going from there, right? When you get above the green dotted line and above the blue dotted line down here, as they move up together. And we are definitely there right now. We are in an intermediate trend mode, not the case for IWM, because it just can't get there, right? It gets up to it and can't get one started, and that's why it's so important to get through that 2 level, 65 level. And IWM has had good bullish moments, had a good bullish moment there. It looks like it might break out. Had a good bullish moment here. It looks like it might break out. Has having a good bullish moment right now, but it can't quite break out. And you can see every moment we pull back after that. You see the 2-line versions of the S&P well above the 30-day moving average, is close to crossing back above the 50-day moving average. Obviously still well above the 200. IWM, we're still converging. Like, again, we're almost back to the point where we can get all these lines, as we saw over here, when all the lines traversed the intraday range. It just shows just how sideways you are when every single line. That's not the case now. We're only getting the 8 and the 17-day moving through the range. The others are all below that. But a little bit of a neutral kind of reversal type candle there. You can see you've got strong support at all of those lines, and we've converged so tightly at some point in time. We're going to break on IWM in a direction, one way or the other. The question is just when and which direction. And as of right now, you lean towards the upside until you break above those highs. But you can see where the downside is, and obviously if you break down below there, it's a free fall below there. The move that got us up to this layer right here, the move that got us up to this was so fast with so little volume that there is this once you break this dotted line 23%, there's no volume until you get down to the pre-COVID high point. So it's very, very easy for it to fall into this area, and there's nothing that can halt any kind of movement that it would make. That's why you have a hedge on for that, because the margin of safety is just so much poorer for IWM than it is for the Qs, which has multiple layers of support on any kind of decline, including at that 23% retracement level. Let's take a look at today's intraday move, and you can see, a very strong 20-day move. You can see there's not very, the volume's all spread out. Lots of still common gaps that we haven't filled in yet, so keep that in mind. In fact, we still have this gap to fill in from, what was that, Thursday. We haven't filled in that gap yet. That's a common gap that you expect to fill in, and so that's we're at 460, and that is down into the 455 range. So it's very, very easily for us to make that move. I wouldn't be surprised if we make that move as early as next week. In fact, that's kind of the direction I'm leaning towards, that we'd make that move and fill in that gap next week. If you'd like to take a look at today's volume, 70 million shares, a range at 4 points, below average on the range. So when I take a look, when I put those numbers into some context here, the 4 points is below the average. You can see the descent on the average is declining, though. We're not really, falling down more, which is what will happen when you grind to the upside. And the volume is also dropped down. It looks to me like they're setting up for higher low points to form. And of course, volatility is also kind of to the point here where it's kind of hard for it to go down very much more than where it's at, because it's already so extremely low. We've finished multiple days around this 80% mark. The last couple days we were above it, but not very much. Every other day below it. And then now the last 2 weeks we finished below the 80% mark with very small ranges, just over 3 points in the range this week, just 3 points last week. So again, for some context on how small those ranges are on a weekly basis, here's the VIX. The average range on a weekly chart for the VIX is over 5 points, and we are at 3 points the last 2 weeks. So below, if you have to go way back for us to have less than a 3 point for the ATR to get below 3 points, we have to go way back to where we are below 15. Well, we're not below 15 right now. We are above 15. And so for us to get 3 point ranges, we're getting some compression and volatility at such an extreme low That's the type of environment that leads to a jump in volatility. Now, whether or not we'll get one remains to be seen, but that's, with the FOMC meeting coming up, there's a potential catalyst for one. But it's the environment, right? You can't forecast tornadoes, but you can forecast the environment that produce tornadoes. And whether they produce them or not is random, but at least you can look for that environment. This is that type of environment. And I do expect that we'll get a little bit of a jump in volatility and more of, coming some weakness coming out of that cluster going into next week. So do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that suggest why you're a lot more bullish going forward from today, not going into today, but going up to today, but going forward from today, why you're a lot more bullish than I am, or why you might be a lot more bearish than I am. Share what drives you to those conclusions with us down in the comment section down below. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. It tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way, or Monday. Quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. But if you do like them and you want to let us know, that thumbs up goes a long way. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions do you have for me? What comments do you have on anything I said or pointed out in the video today? Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right. Click on this Market Outlook Live, where you can come up here and click on Live Trade Review right there. That takes you to this page. This is where I review all the trades we've done in prior Market Outlook videos to see whether we should stay in them, get out of them. We also put on today's trade idea that you'll hear at the end of the video today. We already put it on today before the market closed. We did that in that video here. You can see this at 3:30 Eastern time on this page on Monday, Wednesdays, and Fridays. Also, you can see our upcoming classes that we have. If you click on View More or come up here to Trading Rooms, you can see all of our class schedule, including what we have coming up going into November, as well as 3 years worth of archives posted here on the calendar. If you come over and click this heart icon here, it opens up this new tab. Hit that like button. Also, if you come here, hit that thumbs up icon, it opens up another new tab. Hit that like button. Again, the more you do that, the more it helps get our content out to all of our people that follow us. It also benefits you too, and I appreciate that, Donald. It also benefits you too because it gets your content out. These platforms, Twitter, Facebook, will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. You can do it really quick with just a couple clicks. All right, now let's take a look at what's driving this market. And you can see since October the 4th is when we hit the low point. So from the 5th on, let's take a look at how things have gone from October the 5th on to right now. You can see the biggest gainer by far, and see we gapped up on the 5th, really nice good move to the upside. But from that point going forward, the Qs have really dominated. Initially, emerging markets are doing very well up to a point along with the Qs, but you can see while they have tapered off here, all the way coming down all the way to this point, and commodities also has tapered off. Coming down to this point, and bonds have hit a low point and then rallied from there, and the dollar also kind of rallying here at the very end. It appears that the Qs have kind of done its own thing, a little bit of a divergence, where you had a strong risk appetite, commodities, small cap stocks for that matter. You can see small cap stocks peaked there as well. They're not down as much, but they're relatively flat. All these risk asset classes, including the Qs, were strong up to a point, and then they have continued higher and nothing else has. So, including this past week, this is not necessarily the most risk on pattern this week. It's really been primarily driven higher by the Qs, and you can see even the divergence from SPY has gotten bigger, but tremendous divergence from IWM. From that point. You see that here on this chart. When you look at, let's see, it was this chart here. If we take a look at the Qs relative to IWM, you can see, we've really come off of that. What's about the October 29th? No, excuse me. This would be October the 4th. The Qs have really pulled off. And then here in just the last little bit, from October the 22nd, it's really taken off to the upside too. So very strong breakout move in relative strength for the Qs. You can see the PPO has now turned positive. So we've closed above its moving average. Very strong. DMI, RSI, CCI for this level. So the Qs are really pushing us higher, and we're not seeing that strength broadly. It's very, very focused in these mega cap names. As you can see, initially everything else came along with it, but not since, what would that be, the 20th. Right around the 20th is when, 20th to 21st is when we peaked on all of these. And everything, bonds have been rallying since, and everything else has been falling. From a risk asset standpoint, has been falling ever since, except for the one, which is the Qs there. Let's take a look at some of the other countries too. Let's go to the 12 grid for all the major economies that are out there. Of course, we have dark green shading and a green line in the UK and in France, and Canada has been very strong, and Russia has been pulling back. But look at Russia, look at India. It's in dark pink shading now, not quite below 40 yet, but dark pink shading. Brazil still struggling down there to the downside. Korea, which is a reflection of global economic growth expectations, they're not doing so hot. The intermediate line's at 55, so it's only light pink shading, but we have a red line, and we haven't really changed the trend. You can see China also rolling over. The cluster we got in Italy, near clusters in France and UK, and Germany's not really strongly, it's not changing the direction of the trend. So not necessarily the most bullish pattern broadly that we're seeing right now in the S&P 500 from a global standpoint. Now let's take a look at the sectors and how they have done. And let's go back to that October the 5th time frame from that low point. And we'll go here, and you can see, again, very broad move. You can see the XLK, XLY, but they were joined by financials and industrials and materials and energy all the way up to about this 20th, 21st. But from that time going forward, all these other sectors have been flat to down, and XLC has been down. And XLY has really shot up to the upside, and XLK is kind of continually, gradually moving up to the upside too. So it's really been this strong move. And before today, Amazon, but also Tesla pushing XLY up to the upside, and XLK still grinding to the upside too. And everything else has been at best flat, including the safe haven areas. Utilities and staples were rallying up to that point, lagging but rallying. They've been flat, and of course XLC has been down from that point there. So you can again see what's really driving this action, and the big divergence we're seeing. If I just look at today alone, or this week, excuse me, alone. And here, let's zoom out a little bit so we can see some more periods here. There we go. This is just this week, and look at like this big outlier move in XLY, and we know why. And XLK and healthcare, everything else was down this week. Everything. I mean, small, not very big downs, but financials, industrials, material, energy were all down. So not exactly the most risk on. In fact, it looks like it's more been dragged higher by a handful of mega cap names in a couple of these sectors, and not including the communication services sector, which has all those Meta now, and Google and Twitter and other social media companies, in addition to Netflix and other media companies that would be regular media companies that would be in that XLC space. All right, so for our trade idea of the day, I wanted to take a look at Lennar. Lennar has also been on this bearish pullback during the rest of the market. Got a lot of bullish clusters, a cluster of oversold clusters, excuse me, all at the same time. But then started to bounce back up, got into dark green shading and a green line mode. Dark green shading and a green line, and then has been pulling back. after that. And that happens a lot. In fact, if you take a look at what it's doing on the 2-line chart here, you see that we were below the 200-day moving average, so a little bit of a test, but not long enough to get a death cross, and long enough to bring the 50-day moving average down, bring the 30-day below the 50. The 8 and the 17 are also still below the 50, but you can see we did get above that 23% retracement level of the rally that we had been retracing, that we've retraced a couple of times here, and then now holding that support. Holding support there at the $100 level, nice big round number, $100, and a strong point of control, strong support level. And of course down below it you've got the 17-day moving average, you've got the 30-day, the 200-day, and really the 50-day. You see you're still kind of trading right around that 50-day moving average there, as well as that short-term time frame. So a nice little pullback, but not enough of a pullback to be like bearish, like that, to resume the bearish trend. You can see kind of sitting right at that at the Ichimoku cloud, and we try to get something bullish going, but not quite yet. So there's an opportunity here to kind of bounce off of this, the opportunity to bounce off of this low point and start a new run to the upside. Here's the Bollinger Bands. I showed you the volume profile on the other chart, but here's the Bollinger Bands. You can see how much support is below it. Very significant level of support below there, and we are still in the upper half, so it's a pullback down, which happens a lot. You can see during the pullbacks, pullback down, in this case not getting below the 20-day moving average like some of these, but getting right down to it, and giving us an opportunity to bounce off of it and resume. And so with that, I took a look for November expiration, because we are still 3 weeks away. Remember, we already put this on before the market closed, but we sold the 97.5. We bought the 95. I think we got about 65 cents on it, so we're already up a little bit since we got into the trade. And a normal size position. Here's the filled there. There's the normal size position, so better than 30% return on risk, which is what you're shooting for. High probability trade. All it's got to do is stay above that 97 level. And if you take a look at where that 97 level is on this chart, it is back down below that point of control, right? Back down, all the way down into that area. So you'd have to break back below the 30 and the 200-day moving averages, which at that point we don't want to be bullish on it anymore anyway. So we can be able to take a $325 loss, ideally no more than that, and be able to get out of that and move on if it doesn't work out. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as to our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody, and we'll see you all next week.